Welcome to another episode of the Ontario Mortgage and Real Estate Insights podcast. I am your host, Steve Hamoen. Today we have a lot to discuss, from the latest developments in the mortgage sector to the shifting landscape of commercial real estate. We will also touch on the current state of home sales in Canada's largest cities and explore whether a 30-year mortgage might be the right choice for you. So, let us dive right in. Our first topic today is one that has been making waves in the financial community: the impact of Canadian mortgage borrowers reducing their consumption, even after rate cuts. According to a new staff research note from the Bank of Canada, the sharp and unexpected rate hikes we have seen since 2022 will continue to cause damage, even as rates are now being slashed. The Bank of Canada's overnight rate climbed much higher than initially anticipated, leading to reduced consumption for mortgage borrowers. The researchers at the Bank of Canada had originally forecasted that interest rates would be 2 percentage points lower than the observed peak. This miscalculation was primarily due to an incorrect assessment of transitory inflation and liquidity issues stemming from excess government borrowing. As a result, mortgage borrowers are feeling the pinch, and those who have not yet felt it will soon. The Bank of Canada estimates that the average mortgage payment has climbed by 9% since 2022 and is forecasted to climb to 17% by 2027. By that year, virtually all mortgages will have undergone at least one renewal since the end of record low rates, diverting significant funds from consumption towards servicing debt. The Bank of Canada estimates that higher payments have reduced mortgage borrowers' consumption by 3% since 2022, with this figure expected to rise to 5% by 2027. Interestingly, the researchers note that borrowers with more disposable income are less likely to reduce their consumption. Instead, they are more likely to divert additional cash for debt servicing from their savings. This is somewhat good news for the economy, considering that recent data showed high-income households owe most household credit and have very lofty savings rates. In contrast, most of the population, about 80%, owes significantly less than half of all household debt. The study also emphasizes that the pressure on consumption will last far beyond the current rate cycle. Higher interest means less principal is being paid down, which in turn means future payments will be larger. This creates a cycle where more and more income is diverted towards debt servicing, much like accumulating significant debt would reduce income for consumption. This raises an important question: is this scenario better or worse than the alternative? There is no clear estimate on the secondary or tertiary impacts or what would have happened if low rates had persisted for a longer period. A recent analysis from the United States Federal Reserve labeled this type of analysis as naive, pointing out that higher rates help contain prices. Affordability is not just about the cost of debt, but also the amount of debt. A few years ago, the Bank of Canada made a similar point regarding the impact of low rates on home prices. They found that 30 years of falling rates did not improve affordability for buyers. Instead, home prices simply adjusted to absorb any new credit introduced, making it easier for home prices to rise. The Bank for International Settlements, often referred to as the central bank for central banks, also made a similar point back in 2022. Their analysis warned central banks that maintaining excessively low rates for too long would push home prices higher. It is unlikely that the Bank of Canada missed this point, especially considering its governor also headed the Bank for International Settlements Governors Council at the time. Another issue the Bank of Canada aimed to address with higher rates was elevated inflation, which impacted every household, not just those with a mortgage. Had inflation not been contained, consumption would have fallen significantly in real terms. So, while higher rates have undoubtedly caused pain for mortgage borrowers, they have also played a crucial role in containing inflation, which benefits the broader economy. Our next topic dives into the challenges faced by Canada's largest pension funds in the commercial real estate sector. According to recent reporting by Bloomberg, higher interest rates are pushing valuations lower and tightening the lending environment, prompting these funds to reevaluate their strategies. The Canada Pension Plan Investment Board, for instance, experienced a 5% loss on its property portfolio in the last fiscal year due to the deepening commercial real estate slump. The Public Sector Pension Investment Board did even worse, recording a 16% loss, marking their worst fiscal year performance in this asset class since the global financial crisis. Joe Taylor, the chief executive officer of the Ontario Teachers' Pension Plan, remarked that what has worked well for the last 35 years may not be as effective in the next 5 to 10 years. Consequently, the Ontario Teachers' Pension Plan has shifted authority for most of its future real estate investments away from Cadillac Fairview, bringing them in-house like its other asset classes. The report also highlighted that the Caisse de dépôt et placement du Québec lost 6.2% on its real estate investments in fiscal 2023, the worst return since the onset of the coronavirus pandemic. In response, the Caisse has decided to merge its real estate business with another unit that specializes in lending against properties. This merger is expected to save the plan $100 million annually. According to Bloomberg, these moves toward more streamlined and centralized structures reflect a new blueprint for how some of the world's most prolific property buyers are adapting to the changing landscape. The asset class has become more global and niche, with tighter margins and increased competition from other types of investments. Jim Clayton, a professor at Toronto's York University, commented that the real estate sector is undergoing dramatic changes. He noted that there is also a structural shift in the way we work and live, accelerated by the post-COVID era, which is prompting a rethink of what real estate means today. This evolving landscape is leading Canadian funds to not only change how they invest, but also what they invest in. However, it is worth noting that not all pension funds are altering their strategies. The Ontario Municipal Employees Retirement System, despite a negative 7.2% return in the most recent reporting period, is staying the course. Blake Hutchison, the CEO of OMERS, stated that the organization already works closely with its real estate subsidiary for allocation decisions. He emphasized that the synergies other funds are hoping to achieve have been a part of OMERS' strategy for decades. Our next topic focuses on the recent trends in home sales across Canada's largest cities. According to preliminary data from local real estate boards, home sales in Toronto, Vancouver, and Montreal picked up in June. This marks the first monthly increase in several months for Vancouver and Montreal, and the first rise in 5 months for Toronto. The Bank of Canada's rate cut last month likely contributed to this uptick in resale activity, but experts caution that the market remains sluggish by historical standards. Jason Mercer, the chief market analyst at the Toronto Regional Real Estate Board, commented that the Bank of Canada's rate cut last month provided some initial relief for homeowners and home buyers. However, Mercer noted that the June sales result suggests that most home buyers will need multiple rate cuts before they enter the market in significant numbers. Previous polling by Ipsos for the Toronto Regional Real Estate Board suggests that a full 100 basis points, or 1% worth of rate cuts, will be needed to significantly boost home sales. Despite the uptick in sales from May, year-over-year figures show a different story. Sales are still down sharply compared to last year in most cities, with Toronto experiencing a 16% decline, Vancouver a 19% decline, and Calgary a 13% decline. In Vancouver, sales are nearly 25% below their 10-year average, and some believe the weakness will persist for months as high interest rates continue to weigh on housing activity. Darren King from National Bank Financial weighed in, stating that despite record population growth and a buoyant job market in the region, which should support transaction levels in the coming months, he does not expect sales to jump drastically. Affordability challenges will remain a major issue in the context of a policy rate that, despite upcoming cuts, will remain in restrictive territory for several months to come. While average selling prices remain muted in most markets, Calgary stands out as a notable exception, where prices are up 8.5% compared to last year. Anne-Marie Lurie, the chief economist at the Calgary Real Estate Board, noted that the market continues to be competitive for some buyers, with over 40% of homes sold going over the list price. Here's a quick roundup of the June statistics from some of the country's largest regional real estate boards. In the Greater Toronto Area, sales in June 2024 were 6,213, down 16.4% year over year. The benchmark price for all housing types was $162,167, a decline of 1.6%. New listings rose by 12.3% to 17,964, while active listings surged by 67.4% to 23,613. Jason Mercer from the Toronto Regional Real Estate Board mentioned that the Greater Toronto Area housing market is currently well supplied, giving recent homebuyers substantial choice and negotiating power on price. Moving forward, as sales pick up alongside lower borrowing costs, elevated inventory levels will help mitigate against a quick run-up in selling prices. In the Greater Vancouver area, June 2024 saw sales of 2,418, a 19.1% decline year over year. The benchmark price for all housing types was $1,207,100, a slight increase of 0.5%. New listings were up 7% to 5,723, and active listings increased by 42% to 14,182. Andrew Liss, the Director of Economics and Data Analytics at Greater Vancouver Realtors, noted that buyers appear hesitant to transact in volumes considered typical for this time of year, while sellers remain keen to bring their properties to market. This dynamic is bringing inventory levels up to a healthy range not seen since before the pandemic, providing buyers more selection and driving all market segments toward balanced conditions. In the Montreal Census metropolitan area, sales in June 2024 were up 6% year over year to 7,762. The median price for single-family detached homes was $451,000, up 4%, while the median price for condos was $380,000, also up 4%. New listings increased by 6% to 11,056, and active listings surged by 25% to 38,701. The Quebec Professional Association of Real Estate Brokers reported that the Montreal market is showing resilience with these positive indicators. In Calgary, June 2024 saw sales of 2,738, down 12.8% year over year. The benchmark price for all housing types was $608,000, an impressive increase of 8.5%. New listings were down by 3.6% to 3,798, while active listings rose by 9.2% to 3,787. Anne-Marie Lurie from the Calgary Real Estate Board highlighted that the pullback in sales reflects supply challenges in the lower price ranges, ultimately limiting sales activity. Inventory in the lower price ranges continues to fall, providing limited choices for potential purchasers looking for more affordable properties. Despite this, the market remains competitive with over 40% of homes sold going over the list price. In Ottawa, June 2024 sales were relatively flat year over year at 1,439, marking a slight increase of 0.1%. The benchmark price for all housing types was $647,700, down 0.5%. New listings were up 4.7% to 2,469, and active listings surged by 45.5% to 3,585. Curtis Fillier, the president of the Ottawa Real Estate Board, noted that Ottawa continues to see steady activity as we head into the summer market. Buyers have more room to wait, evaluate, and be selective when searching for the right property at the right price, leading to a slight uptick in the days on market. Sellers are making moves as evidenced by the increase in inventory and listings. Our final topic for today is one that has been a subject of much debate. Should you get a 30-year mortgage? With the evolving landscape of the mortgage market, this is a question many prospective homebuyers are grappling with. Traditionally, Canadian mortgages have been structured with shorter terms, often 5 years, which are then renewed at the end of the term. However, the idea of a 30-year mortgage is gaining traction, especially among younger buyers and those looking to manage their monthly cash flow more effectively. The primary advantage of a 30-year mortgage is the lower monthly payment. By extending the amortization period, the amount you need to pay each month is reduced, making it easier to manage your monthly budget. This can be particularly appealing for first-time homebuyers or those who are looking to maximize their cash flow for other investments or expenses. However, it is important to note that while the monthly payments are lower, you will end up paying significantly more in interest over the life of the loan compared to a shorter-term mortgage. For instance, on a $500,000 mortgage with an interest rate of 3.5%, the total interest paid over 30 years would be approximately $308,000. In contrast, a 15-year mortgage at the same rate would result in total interest payments of around $143,000. That is a substantial difference, and it is something to consider carefully. Another factor to consider is the impact of interest rate fluctuations. With a 30-year mortgage, you are committing to a long-term financial obligation, and while interest rates may be low now, they could rise in the future. This could result in higher payments if you have a variable rate mortgage or if you need to renew your mortgage at a higher rate down the line. On the flip side, locking in a fixed rate for 30 years can provide a sense of security, knowing that your payments will remain consistent regardless of market fluctuations. This can be particularly beneficial in a volatile economic environment where interest rates are unpredictable. It is also worth noting that the longer amortization period can provide more flexibility in terms of financial planning. For example, if you anticipate changes in your financial situation, such as starting a family or investing in a business, the lower monthly payments can provide the necessary breathing room to accommodate these changes. Ultimately, the decision to opt for a 30-year mortgage depends on your individual financial situation, long-term goals, and risk tolerance. It is crucial to weigh the pros and cons and consult with a financial advisor or mortgage broker to determine the best option for you. And that wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. I hope you found our discussions on Canadian mortgage borrowers, commercial real estate challenges, home sales trends, and the considerations for a 30-year mortgage informative and helpful. Thank you for tuning in, and we look forward to bringing you more insights on the next episode. Until then, stay informed and make well-informed decisions. Goodbye.